Hey everybody, I just want to give you a quick update. It's Saturday, October 18th, 2008. Sitting here in my dining room area looking outside at the beautiful fall colors. Quick update on what's going on at work. Company's still going pretty good here. We've had some tough row to hoe here lately, but things I think are getting better on the upswing. Obviously, some of the issues in the economy and especially in the banking industry have had an impact on my specific bank where I work. But we've endured through most of it, and hopefully the credit crunch, the liquidity crisis that's been going on in the banking industry will begin to ease. I think it will. I think the liquidity piece will ease. I think banks will start to loan more freely to one another. The obvious problem here is no one really seems to know what the value of the underlying assets are for some of these mortgage-backed securities. So it's hard for someone to buy something when you're really not sure what it's worth. Most financial instruments are valued based on what the perceived or expected future cash flows are. And so if you don't know what those are going to be, because loan losses may come in higher than expected, then it's hard to pay a sticker price for something when you're really not sure what that's going to end up being. So that's kind of what's inherent in the system. If you think about banks are issuing new mortgages and they're still securitizing those mortgages in bundles and selling them to the secondary market. But the problem being that the secondary market has a hard time knowing what the value of those bundles of mortgages are. And so it's hard to put a price tag on those. And then on top of that, what's happened in the past here that we're trying to unwind is after the secondary market, taking new assets, new financial derivatives, and overlaying them on these mortgage securities. So it gets pretty distant from the source very quickly. And that's what's been going on the last couple years, actually several years, and especially as you've had a demand-pull situation where both government-backed entities like Fannie Mae and Freddie Mac and security houses like Lehman Brothers, etc., have issued securities and pulled demand through the system. So the banks and mortgage brokers have been supplying, if you will, as much paper, mortgage paper as has been demanded. And so since there's been quite a bit of demand in the past few years for lower quality paper, that's been repackaged and sold to investors. The banks and mortgage brokers have been glad to provide it. Well, unfortunately, the music came to an end, and few chairs were left to sit on, and many of the banks had to take those assets on books instead of reselling them. And so we're working through those, including our bank I work at. And one of the issues now isn't so much having to value down those assets, which we put on books, but now it's the actual loan losses which are coming through. So now we're having to work through those loan losses as people become late on their payments, and then a certain percentage of them default and fail to pay. And of course you have to write those off. We call those charge-offs, and you have to charge those accounts off and take the hit to earnings when those happen. Well, this first wave, which began in August of 2007 through probably the middle of 2008, most of the hits that you saw, the billion-dollar write-downs from all these large financial companies, have been valuing down the paper assets that they bought in the secondary market. Now what you're going to see is something which really in some ways is just as serious, if not more serious, is actually seeing hits to financial service companies, including banks and especially banks, for the loan losses, the real loan losses to home equity loans and credit cards and mortgage assets that they didn't sell, that they have to keep on books. Those things are now coming to fruition. So the banks now have to write off the actual bad debt. So you've kind of had a double whammy. The first whammy in the first wave of this has been just the paper losses, and the second wave has been what's coming now, which is the actual loan losses. So there is light at the end of the tunnel, because at some point the economy will begin to turn. There will be a secondary market for these paper assets, which will find a price, and that's one of the real problems, is just price discovery. Just as if you didn't know, what the true value of a used car was, you wouldn't want to go into to a used car dealer or buy it out of the paper without having done some research and knowing what the Kelley Blue Book value is for the car. In the same way, there's got to be price discovery that enters back in, transparent price discovery entering back into the system. And once that occurs, then you're going to be able to find a market for the securities. And once the market stabilizes, you'll be able to have liquidity again. And banks have to keep loaning. The other problem is that as loan losses increase, loaning money becomes less and less profitable, which leads me to one of my diatribes here as far as the most recent bailout. Because the most recent bailout, injecting capital directly into the banks, is helpful for liquidity and to kind of weather the storm. But if you understand anything about banking, banks usually lend about 10 times as much as they hold in capital. So a bank, if they have $1 billion, for example, in capital, the theory is that they'll hold that $1 billion in capital in reserves and then lend out $10 billion against it. And this is called the multiplier, the multiplier effect that banks and the Treasury and the Fed uses in order to determine money supply in the economy. So the theory is if you give the banking system another $100 billion, that'll equal $1 trillion in lending. Well, lending is needed because businesses have to be lent to. Businesses require lending in order for their operations to go forward and for them to plan things and to expand and to create jobs, because if you can't make plans and start projects and create jobs and expand, you don't grow. And so if financing becomes scarce because banks won't lend, then companies have to lay off. So there's a negative spiral effect that occurs. Now, for the banks, though, the problem right now is as loan losses increase, it pinches their spread on loans and their profitability. So my personal thought from this is that the multiplier won't be 10 to 1 anymore with the increase in capital, because banks are going to be defensive, I believe, with much of this capital. So the assumption rather by our officials that increases in capital of the banking system is going to have a tenfold multiplier effect, I think is faulty. And it's faulty because if you look at the P&Ls, the profit and loss statements of the banks right now, they're getting very thin. New capital doesn't necessarily mean new lending. So there's an issue here we have. And if the economy continues to deteriorate, banks are even less sure that they'll get paid back. And so there's a natural tendency in fear to pull back on lending. And I can tell you that's happening now in mass in the industry. And so more capital right now really is, I think, in the most part, will be employed to weather the storm versus taking great steps to lend. So I think that the multiplier is not 10. I think it's something way south of 10. And depending on the amount of fear and distrust in the system, it could be considerably less than 10. So the thought that we're adding $250 billion by taking a equity share in banks and providing this capital to banks is going to equal $2.5 trillion in lending, I think is extremely, extremely faulty and very well could not work in the way that we think it might. So the other thing that we may need to be aware of, and really it comes down to the root issue, is that what has to happen is people have to become more sound financially. Companies need to be able to pay their bills better, and people need to be able to pay their bills better so that loan losses come back down, banks can then lend, their P&Ls improve, and there's an incentive to lend. And once that incentive returns in the market, lending won't be a problem. But right now you have a pretty big disincentive to lend because of increased loan losses. And that's this installment.